Hello traders, Jeff with optionboxer.com, back again with another strategy video. This one is going to be a little bit of a hedged strategy, but before we get into the mechanics of it, please know that I am not a registered financial advisor, and this video is not a recommendation for you to buy or sell any security or place any options trade. Please make sure you're doing your own research prior to trading, and please make sure you understand the disclaimer at the beginning of this video. That being said, I've got a spreadsheet that I created to kind of track this particular strategy. And just really quickly, you got the balance details, the credit risk details. Weekly target doesn't really apply for this back-tested data because it's set up for 2021 and beyond, and not for 2018 or 2017 or so forth. And then the win-loss details will just break down how many wins you had, how many losses, the average win, the average loss, largest win, largest loss, and you can see that data there. I'm trading this strategy just on the SPY, and it's more of a systematic approach to options trading. And you can see with the back-tested data that I have entered here, I'm up by $65, and that does account for commissions. Oh, well, most of them. I didn't drag this all the way down. So I'm actually up by $57 after you take out commissions for each trade. So with this spreadsheet that I have here, I have to enter both the opening and the closing trade so that it calculates appropriately. And then the 1%, 2%, 3%, this information here will make more sense once we take a look at the strategy here. So basically, we're going to sell a put credit spread for the 1%, which you saw here was $29. So our first trade would be around 29. You can see it's going to vary a little bit just based on what the market gives you. And then the second put spread will be a little bit further out in time, and that will be at the 2% mark. And then the third one a little further out in time, and at the 3% mark. And then we're going to wrap all those in a long put spread or a debit spread even further out in time. A couple of key points here that'll make more sense as we look at this strategy is we want to roll the short spreads when a 60% profit is achieved. We want to roll the long spread when a $200 profit is achieved, or if there's only 2 weeks remaining. The long spread is more of a protection, and so we really don't care if it goes to zero, but we want to keep it as active as we can. So we want to put that, we know with if you've ever traded options before, you know in the last couple of weeks that that rate of decay really accelerates. So we want to try to avoid some of that rate of decay, by keeping this further out in time. So if it gets to 2 weeks, we're going to roll it out. And then trade the long spread 4 points wide under the 4% limit. No more than 4 strikes in or out of the money. That's kind of a general rule. You may have to go 5 strikes at some point, may have to go 3. Well, you will want to go 3. If you can get 3, that's even better. But at some point, you may have to go a little wider, but typically no more than 4. I'm not going to rebuild this. This is the second attempt I've tried to make this video, and it just gets too confusing for me to keep the video flowing while I try to enter the data and set the trades up here on Thinkorswim. But I will enter the first round of trades right here, and I'll show you how this sets up, and then what the rest of this is without setting up each trade and managing it while I'm trying to make the video. So the first trade I'm going to set up is going to be at the 1% credit mark, which is $29 at this moment. That number on this spreadsheet will change so 30 would be good there. The next one we're looking at is 59. And again, remember, we're going to go out to the next 7 days or 14 days in this case. And now we're trying to get, I believe, 59, 59, 23. But we don't worry. It doesn't have to be exactly on it. And in fact, I don't think it ever will be. Typically, you have to go $2 wide to get the credit you want. Sometimes you can get lucky and get a credit. So we'll take the one right at the money for 52. That's close enough, and it avoids some of the risk of having the wider spread open. Then we're going to go out another 7 days. This time we need to collect $88. And we will have to probably open this up $2 wide. And 90 is probably about as good as we're going to get. But we'll go 84 just to give us a little different look there. Looks like this is a losing strategy. I'm not sure why that line is straight there, but regardless, we're going to go out to 28 days, and we're going to wrap all this in that put spread that we talked about, trying to stay around 4 strikes out and keep this under this amount. So we need it to be less than 118. So we need to adjust that. See, and you can see I'm already going to have to break my rule here and go a little bit further out. So you either have to go further out or you'll have to go less. So 1, 2, 3. So we'll have to go 3 strikes out, and that's close enough. But just keep in mind we've got a $1 width strike spread here. We've got another $1, so that's $200 in buying power plus 200. That's $400 in buying power, and we only have $1.80 in protection for that. So I don't love the 1-to-1 ratio there. But it does give us a little bit of protection, so we'll trade forward and see how it goes. But basically, with all these set up, you're looking for a 60% profit on each of these. Once you receive the 60% profit, let's just skip ahead to the 25th. Well, the 24th, I guess. You can see that was a max loss, so we would document that as a max loss. But at this point, I would want to close because we've already achieved about 100% of the profit there. I would want to close and reopen this, but we'll just go in order. So I would close this and I would reopen that at the back end of this, so January 15th. So we would skip ahead to December 24th. Then I would take a look at January 15th, and I would want to go to the back end of that. So it looks like the strikes have switched there, and I'd want to go to January 18th and reopen this single spread here for around 30 cents. Again, maintaining the same 1, 2, 3, 4%. This was a maximum loss, and I'd close that and then reopen it, and then I would skip ahead until this was either at a 50% profit or it was at max loss, and it looks like it'll probably be at a max loss on January 1st. And it looks like it is. So yeah, it was a max loss. We would close that and reopen it and do the same here. So we'll just go ahead and go to the 8th. January 8th looks like that one was a max profit. So again, I would close that and reopen it. Of course, each day that you close a position, you're automatically reopening it. I hope that's clear. And then the long spread is going to stay open until it either, again, I would have closed this one already and reopened it when we had that $100 because we had already taken most of the profit out of this trade. And I would have closed it and reopened another one to keep my profit as much as possible. But the only way you close this is if it does reach, the majority of the profit potential, or it gets within 2 weeks to expiration. So I would have actually closed this one on the 4th, and I would have rolled it. I wouldn't have closed it. I would have rolled it. All of these are, I guess you could call this a rolling strategy because you're just going to roll them out, and then you would roll it out to whatever point. So I didn't tally up the profits and losses here because again, it was just too complicated for me to try to do that and keep the video rolling. But you can see here, this first round of trades, I sold a credit of 29. I sold another credit of 59 and then 79, which is pretty much in line with my 1, 2, 3% here. And then I paid $1.16 for the long credit spread. And you can see this is the closing portion of these trades. You can see I closed that one for a max profit. I closed that one for pretty much a max profit. And then I closed that one for another fairly large profit. And then I sold to close the long spread that I paid $1.16 for. I sold it for a loss, and you can see that denoted here in the gain loss column. By the close, you can see I got my next round here. Like as I said, once I closed this one, I just reopened it immediately. I didn't wait for all of these to close. These went 50% or 60% at whatever point they did, and then so every time they did, I just rolled it out to the backside of my furthest expiration month. So if my furthest expiration month was January 22nd, I would just go 7 days away from that or close to 7 days and then reopen it there. Hopefully that makes sense. It's kind of hard to explain without walking through it, but I just wasn't able to do it in a reasonable amount of time. The last video ended up being about 30 minutes long, and that's just too much. But anyway, selling to open here for 30, 58, 88, and then buying to open the 124. And you can see I lost the money there. I had to close it for a max loss, another max loss, and then I made a small profit there. And then I had to close the long spread at a partial loss as well. So I was down initially, and then I came back and opened some more, and then ended up closing the first one for a max loss, but then profited on the next three. You can see the market declined at some point during the life of this long spread, and it made me a nice $200 profit there to kind of cover up some of these losses. And then a little more expected move here, I guess I should say, where my this last round of shorts was actually went profitable. I guess the market went higher, and I ended up taking a maximum loss on the long spread. But all that works out to a total of $57.44. And I know what you're thinking. You're saying, "Oh my goodness, that's a lot of work for $57." And you're right, it is a lot of work for $57. But think how much work, if you've traded options before, think how much work you've done to lose money. And this is a fairly consistent way. It's a hedge strategy. It keeps you engaged with the market on a regular basis. But it doesn't expect you to take trades every single day. It just expects you to look at the market, check your positions, and it just creates it. I guess I don't know how else to explain it. It creates good trading habits, in my opinion, and it keeps you looking at the market every day. It keeps you managing your position, and that way you don't run into the problem that I sometimes do, where I overtrade or I trade different strategies for no good reason. And so I've set up this account and this spreadsheet that I've called Path to $1 Million. I don't think I talked about that, but that's just basically, I'm trying to turn that 2,700 into $1 million, and I broke it down here how it would compound, and then that uses the weekly targets to reach that goal. Will I ever do it? Probably not. Will it ever get that far? Probably not. But again, just putting it on paper so I have something to shoot for every single week, and we'll see where it lands. But that's about it. I apologize. The video got a little longer than I wanted it to. I know I talked fast. Hopefully it made sense. If you have any questions, feel free to reach out to me in the comments. I'm happy to clarify anything that you may need me to. But thank you so much for watching. And if you've gotten to the end of this video, please like, comment, or subscribe. It really does help me out, and I appreciate it very much. If you have any questions, reach me in the comments or at jeff@optionboxer.com. Thanks for watching. Bye-bye.